Hello, everyone. This is Marc from Maple Capital Partners, and today we're going to be rounding out our top 6 reasons why you should invest in U.S. apartments. So if you remember from our last newsletter, we went over our top 3 reasons. So just to recap, that was demographics, pent-up demand, and barriers to homeownership being historically high. So all 3 of those factors are really demand side drivers. Whereas today we'll cover a little bit more on the supply side, as well as what we think makes real estate really stick out. So reason number 4, apartment construction is insufficient. As we've touched upon in prior videos, the new supply of housing units is not sufficient to meet the demand that's coming from the growing household formation of the millennial demographic, as well as baby boomers. The housing production has not kept up with the population growth for the last 40 years. This is nothing new. While it has gotten worse since the '08 recession and the decline of a lot of developers during that time period, it's nothing that we haven't seen before. It's in fact been a downward trend since the 1970s. In fact, one of the most stark differences today from prior generations is the lack of entry-level starter homes, those homes that are less than 1,400 square feet. That's decreased sharply since the Great Recession and is actually down more than 80% since the 1970s. Similarly, entry-level homes are becoming a smaller fraction of new homes that are being completed. Today, that fraction represents 10%, meaning 10% of all new homes are in that entry-level category. That compares to around 35% for the same number in the 1970s. So these dynamics mean that the critically important bottom rung of the home ownership ladder is far too out of reach for new families trying to start building their wealth through their home. In fact, as of 2021, there was a 3.8 million unit shortage of homes overall, which is up from just 2.5 million in 2018, just 3 years ago. That gap is only getting worse. So even last year, when we had the largest supply of new household units being produced in 10 years, that gap was still nearly 500,000 units. And that supply-demand imbalance is one of the reasons why we really believe that U.S. apartment investing is so compelling. The next reason number 5, attractive risk-reward characteristics versus other asset classes. So Sharpe ratio is a ratio that we talk a lot about in financial circles. And what it really is it's the ratio of risk to return. In this case, a higher number is better. As we see from this graph here, the Sharpe ratio for NPI, and that's really commercial real estate in general, is the highest versus all other major asset classes over the last 20 years. Keep in mind that NPI, sometimes called NCREIF, is a property index that reflects all categories of commercial real estate, not just apartments. When we strip out all of those other sectors of commercial real estate, so retail, industrial, hotels, all of that other stuff, the Sharpe ratio is actually even higher for just apartments themselves. So all that is to say that your risk-adjusted return by investing in apartments is much higher than you would get from listed REITs, corporate bonds, government bonds, stocks in general. And to round out our top 6 reasons is diversification. Research shows that private real estate has a relatively low correlation with other asset classes and may help reduce the volatility of a stock and bond portfolio. The graph on the lower left shows those correlations. That's called a correlation matrix. And for those who may not have any understanding of correlation, basically those values range in number from 1 to -1. 1 means that 2 different assets, say private real estate and equities, move completely in tandem. So as one goes up, the other goes up to the same magnitude. -1 means they're directly inversely correlated, meaning as one goes up, the other one goes down in a completely proportional amount. As you can see from that graph, private real estate is has relatively low correlation with those other major asset classes. In fact, it even has a negative correlation with some of them, which means that you'll be well diversified by having some exposure to private real estate in your portfolio. In fact, a lot of people will often invest in public REITs, thinking that that gives them some exposure to real estate and diversifies themselves away from their stocks. But in fact, looking at these numbers, public REITs are much more highly correlated with equities than private real estate. So you're not getting the same benefit as directly investing in real estate itself. On the right, you'll see a few charts there which display your average annual returns and standard deviations, which is a measure of volatility, for a distinct set of portfolios. And what becomes very clear is that as you look at these portfolios, and I'll point out that the orange sections are the portion of the portfolios devoted to real estate, commercial real estate, that as your commercial real estate becomes an increasingly larger portion of the portfolios, that the Sharpe ratio, that is your risk-adjusted returns, go up. So not only do your returns go up, but your risk declines, meaning that by adding commercial real estate to your portfolio, you should have much more favorable outcomes over the long term. So that closes out our top 6 reasons why you should invest in US apartments. So to recap, those top 6 reasons are demographics, pent-up demand, barriers to homeownership being high, apartment construction being insufficient to meet demand, attractive risk reward versus other asset classes, and diversification. Now, next time we're going to cover our bonus reason number 6, which are the tax advantages of investing directly in commercial real estate. We hope you've enjoyed this. And on behalf of Maple Capital Partners, be happy, be charitable, and invest wisely. We'll see you next time.